Welcome to the 7th episode of our Accounting Basics series. Today we're going to be covering accruals and prepayments. So before we get started on this video, if this is the first video you're watching, I'd highly recommend watching the accruals basis accounting video that I have uploaded to this playlist. Basically, it outlines the basis of why we use accruals and basis accounting, and more importantly, what it is. So in this video, we're going to be covering what are accruals and what are prepayments. I'm going to give you an overview of the definitions, why we need to use them, and more importantly, how we use them. So let's start with accruals. The definition of accruals is a charge for work that has been done but not yet invoiced, for which provision is made at the end of a financial period. So what does this mean? A charge for work is pretty obvious. It's just essentially recognising the expense. Not yet invoiced means we just haven't received a bill for it. The provision is essentially the liability we are recognising in the balance sheet when we credit accruals. And finally, the end of a financial period just relates to the period you're reporting on. Now, I know what you're thinking. We usually debit the expense when we post the bill. If you watch the debits and credits video, you'd know that posting a bill is debit expense and credit accounts payable. But under the accruals basis principle, we need to recognise the expense in the period in which it relates. This is where accruals comes in. In order to recognise the expense in the right period, we use the same method as posting a bill, except instead of crediting your accounts payable, we just credit accruals instead. Then when we finally receive the bill, we post it as normal. The catch here is that as soon as you post the bill, you must reverse your accrual posting on the same day as the bill entry, so you don't double count the cost. So let's go through an example. We're doing the January management accounts for XYZ Limited. We're completing this work in February to ensure all January transactions are included. However, as we are providing accountancy services relating to January management accounts, we need to ensure that we recognise the cost of our accountancy services in their January profit and loss. However, we'll have to invoice in February as this is when we'll be doing our work. So let's post an accrual for this. We know the cost needs to hit the P&L in January, so we post our accrual on the 31st of January. Our double entry for this is debit accountancy expense in the profit and loss and credit accruals in the balance sheet. Perfect, we've captured the cost in January. Now what happens when we post our bill in February? We just post it as normal. We debit the accountancy expense and we credit the accounts payable. But now we've got the cost in both January and February, so that can't be right. So here's when we reverse our accrual. This needs to happen in the same month as the bill is dated, so they zero off in the monthly profit and loss. So now we've covered the accruals, let's move on to prepayments. Prepayments, the definition is the sum paid for goods and services before their receipt or invoiced due date. Essentially, this is the same as an accrual. However, where accruals are recognised as an expense for a bill you haven't received yet, a prepayment is where you are stopping an expense being recognised as the bill has been received before the period that the cost relates to. Now, that's a lot of words and it may be a bit confusing, so let's do an example to visualise this. We're an accountancy firm and we have our office in the heart of London. We receive a bill in January for our quarterly rent, which covers January, February and March, and this bill is for £30,000. So we post the bill as normal, we debit the rent expense and we credit the accounts payable. But now we've got rent costs for February and March in our January profit and loss, and that can't be right. Here's where our prepayment comes in. We need to work out our February and March portion of the bill, which is going to be 2/3 of our invoice, so £20,000. On the 31st of January, we post the following. We credit our rent expense. This is because we want to reduce our expense in January by £20,000, so we're only left with the January portion of the cost. We then debit our prepayments on the balance sheet. Now, when we get to February, we want to recognise £10,000 of the expense on this month's profit and loss. So what do? We post another entry. We debit the rent expense of £10,000 because that's the February portion and credit prepayments. This now means that we've got the right amount in February and our prepayments account on the balance sheet only has £10,000 left in it. We repeat this step for March and there we go. 10,000 in each of the month's profit and losses and nothing in our prepayments account. So I hope that makes sense. If you need to watch the video a few times, then obviously feel free, and if you've got any questions, if I haven't explained myself properly or you just want to know a little bit more, then drop it in the comments below and I will respond to every comment I get. If you enjoyed the video, please like, subscribe, and I'll see you on the next one.